Silver ran up, kissed 93.90, and then got slapped back like it hit an invisible wall. Not sentiment, not profit-taking, not some trader got nervous. It looked like a rule. You may approach $94, but you may not cross it. And if you've been in this market long enough, you know the feeling. That moment where price stops behaving like a crowd and starts behaving like a gate. Tonight, I'm going to walk you through the math of that gate. No mysticism, no vibes, just mechanics, futures, margin, options, dealer hedging, and the one thing nobody wants to say out loud. If silver breaks $100 in a disorderly move, the losses on concentrated short exposure don't stay contained. They can become systemic. This is not financial advice. This is an educational breakdown of market structure and risk mechanics. Do your own research. Now, let's talk about why $94 looked like a fortress. The not allowed level. First, what does defend a level actually mean? It means supply appears in size the moment price touches a boundary, and it appears repeatedly, and it appears fast enough to absorb every buyer who tries to push through. In futures markets, that supply can be new short selling, short-term selling paired with buy orders lower, a sell the top, buy the dip trap, algorithmic liquidity walls, options-related hedging, dealers selling as calls go in the money, or a coordinated risk response from a small set of large participants who cannot tolerate price crossing a line. The key phrase is small set, because silver is not Apple. Silver is not a trillion-dollar equity with thousands of institutions on both sides. Silver is a thin market compared to global money flows, and thin markets are where concentration matters. So when you see a level defended with military discipline, the first question is not, what does the crowd feel? The first question is, who has the size to do that? Why 94, not 95? You might be thinking, hold on, if the big psychological number is $100, why fight at 94? Because defenses rarely start at the castle gate. They start at the bridge. Levels get chosen where three things overlap. A prior swing high, where technicians place breakout orders, an options cluster, where hedging flips from gentle to violent, and a risk threshold, where internal stress testing turns from annoying to unacceptable. So $94 can be the bridge, $95 the courtyard, and $100 the throne room. If you stop the crowd at the bridge, you don't have to fight inside. Also, margin rules in VAR models don't care about round numbers. They care about volatility and worst-case scenarios. A move from $86 to $94 is already a massive percentage change. A print above $94 can force risk systems to re-rate the entire book. Higher volatility assumptions, higher margin, higher collateral demands. That alone can change behavior before the market ever sees 95s. The concentrated short problem. Let's be careful and precise here. People love to name names. I'm not doing that. I'm talking about large dealers, bullion banks, and a handful of big clearing members. In many commodity markets, the short side can be concentrated. It's not automatically illegal. It can be hedging. It can be market making. But concentration creates one dangerous reality. At certain price levels, those shorts stop being a trade and start being a risk event. Who are the shorts? A quick map. When people say banks are short, they usually imagine a single villain pressing a red button. In real markets, it's messier. There are several categories of short exposure. Producers hedging future output, they sell futures to lock a price. Industrial consumers hedging costs. They buy futures. The opposite side exists because someone sells. Swap dealers and market makers who take the other side of client flows. Managed funds who short for macro reasons, rates, dollar moves, risk off. Dealers who carry short exposure because they sold call options or structured products. The reason the concentrated short idea matters is that category 3 and 5 can sit on very large, very leveraged books. They may not be short because they hate silver. They may be short because they are providing liquidity, making markets, or warehousing risk that clients pushed onto them. But whatever the origin story is, the P&L doesn't care. Short is short, and if the exposure is concentrated in a few balance sheets, the defense becomes a balance sheet decision. The data people point to and how to read it without losing your mind. There are public summaries that bucket positioning, commercials, manage money, dealers, and so on. Those reports do not give you a perfect x-ray of who is doing what at the exact minute price hits $93.90, but they do help you understand the possibility of concentration. If, in a given period, a small group of entities is responsible for a large share of net short exposure, then the market can behave like it has hands on the steering wheel. Again, that's not automatically illegal. It's a structural feature. The takeaway is simple. If the short side is concentrated, certain levels will be defended not by belief, but by risk tolerance. So when price hits a line and instantly rejects, you're watching risk tolerance express itself. The contract math that changes everything. On COMEX-style silver futures, one contract is 5,000 ounces. So the math is brutally clean. A $1 move in silver, $5,000 per contract. Now imagine a large participant is net short 20,000 contracts. 20,000 contracts x 5,000 owes Yesager 100,000 ounces. Now run the P&L. If silver moves $1 against that position, 20,000 x 5,000, Yesager $100,000. That's $100 million for a $1 move. Now $5 against them, that's $500,000. Now $10 against them, that's $1,000. And now we get to the psychological line that changes behavior. $94 to $100 is $6. On 20,000 contracts, that's 6x $5,000, $30,000 per contract. $30,000 x $20,000 and $600,000. $600 million just from $94 to $100 on that one exposure size. And if the net short is larger, say 40,000 contracts across a handful of entities, double it. This is why $100 becomes more than a number. It becomes a stress test. The single most important fact about silver, it's small. Relative to global capital, silver is tiny. That means small amounts of aggressive buying can move it, small amounts of aggressive selling can move it, and if a few entities decide they must move it, they often can, at least for a while. Think of it like a narrow hallway. In a wide stadium, one person can't control the crowd. In a narrow hallway, a few people can block the exit. Silver is a hallway market. That's why it attracts both passionate believers and hard-nosed traders, because it's one of the rare places where structure can overpower narrative. Why $100 is a different kind of break. Markets don't move smoothly when they break psychological barriers. They gap, they trigger stops, they trigger margin calls, they trigger risk committee phone calls where someone says, "Close it, now, I don't care the price." And that is the nightmare scenario for a concentrated short. Because the exit door is not wide, if you are short, you must buy to cover. If everyone is short and must buy at the same time, the price can jump in discontinuous steps. That's how squeezes happen. Not because the world decides to punish someone, but because the structure forces the same action from too many participants at once. So if you are a big dealer carrying a short that is manageable at 88.8s, uncomfortable at 92s, and catastrophic if the tape prints 100, you do not hope it doesn't happen. You build a defense line before it happens. That defense line, in our case, looked like 94. The options trap. The gamma wall, now we add the part most people ignore. Options. When silver approaches a round strike, 90, 95, 100, there is often massive open interest in call options. If price gets close to those strikes, the options start behaving like magnets. Here's the simple version. If you buy call options, someone sold them to you. That seller is often a dealer who hedges their risk by buying futures as price rises. That's called delta hedging. But near big strikes, hedging can accelerate. Price rises, calls become more sensitive, delta increases, dealer must buy more futures, buying pushes price higher, delta increases again, dealer buys more, feedback loop. That's gamma. Now flip it. If the market fails at a level and price drops, those same calls lose sensitivity, dealers unwind hedges, they sell futures, selling pushes price lower, feedback loop downward. So if there is a massive cluster of options around $95 and $100, a defense at $94 can do two things at once. Stop the magnet from pulling price into the $95-$100 strike zone, trigger the reverse gamma unwind that shoves price away from the danger zone. This is why the rejection can look violent and unnatural, because options hedging is mechanical. No emotion required, just math. What the tape looks like when a level is defended. When price is climbing into a breakout, you usually see bids stepping up, buyers willing to pay higher, offers pulling, sellers backing away, quick prints that don't retrace. But when a level is being defended, you see something else. Offers appear before the level, like landmines. Every time buyers lift the offer, a new offer refreshes. The last traded price can't advance because supply is constantly reloading. To the naked eye, it looks like, why can't it just tick higher? Because someone is feeding it contracts. Nobody watching a chart can prove intent, but you can read pressure. If the tape keeps getting smothered right under the same number, that's pressure. And pressure is what you feel when a few players decide a line must hold. The invisible wall tools, icebergs, stop runs, and speed. Here's why it feels personal when you're watching it. You're not seeing the full order book. Large players don't usually show their whole hand. They slice size, they reload offers, they use algorithms that drip liquidity in a way that looks like infinite supply. That's how an invisible wall gets built. And then comes the second move, the stop run. Most breakout traders place stops in obvious places, just below the last swing low, just below the breakout line after they buy, or just below a round number. So if you can shove price down through a thin pocket, you don't have to keep selling forever. You just have to trigger the stops. Stops become market sells. Market sells hit an already thin book. The drop accelerates, and suddenly everyone thinks the breakout failed. It's not magic. It's predictable human behavior meeting predictable order placement. Add speed, and it gets worse. In fast markets, the difference between 93.90 and 93.60 can happen in seconds. If your broker routes slowly, you experience the move as a jump. That's where people start saying, they teleported it. What really happened is, the book emptied. The prince ran to the next bids. The Fortress Playbook. A defense usually follows a pattern. Step 1. You let price run until it reaches the line, because you don't want to waste ammunition defending $91 if your real problem is $94. Step 2. As price approaches the line, liquidity thins. You see fewer offers. Spreads widen. Step 3. The moment price taps the line, a wall appears. Big offers refresh. Every buy gets absorbed. Step 4. If buyers persist, you hit the market. You don't just offer, you slam, you force the candle red. Step 5. Once momentum breaks, you flip the psychology. Late buyers panic, momentum traders reverse, stops trigger, the move feeds itself. And here's the twist. After the flush, the defenders can buy back lower. They don't need to win forever. They need to survive the level. If you are short and you can prevent a break, you can. Cover some into the flush, roll exposure to later months, reset hedges, reprice risk, and live to fight another day. So $94 is not just a price, it's a checkpoint for survival. The defense has a cost. Here's the math. Suppose the market is trying to break $94 on heavy momentum. To stop it, the defenders need to sell enough contracts to absorb breakout buyers, stop entry orders, and algorithmic momentum flows. Say that combined demand at the breakout moment is 15,000 contracts. At 5,000 ounces each, that is 75,000 ounces of paper demand. To hold the line, the supply side needs to match that fast. So if you see a rejection that happens instantly, you are likely seeing selling in the thousands of contracts, not dozens. And here's the twisted part. If the defense succeeds and price drops $2, the defenders can buy back some of what they sold at a profit, reducing their net short and restoring ammo. So a defense can be self-funding. That's why it can repeat. The margin engine. Why moves turn into cascades? Futures are leveraged. You don't pay 94 Tsatek's $5,000, $470,000 to control one contract. You post margin, often a small fraction of that, depending on volatility and exchange rules. So when price moves against you, you don't just lose on paper, you get a margin call. Now imagine a short position bleeding as price rises. $1 against you is $5,000. $5 against you is $25,000. $10 against you is $50,000 multiplied by thousands of contracts, and you're not down. You are required to post cash today. If you can't post cash, your broker reduces your position. Reduction for a short means buying back. Buying back pushes price up. Up triggers more margin calls. Cascade, that's the squeeze engine. So if you are a large entity and you can prevent the tape from printing the level that triggers that cascade, you do it. Not because you are evil, because the system is built on leverage and collateral. The liquidity vacuum, trick. Sometimes it feels normal, and then suddenly there's no bid. Price falls through levels like the floor vanished. That's not always a conspiracy. It can be a liquidity vacuum. Liquidity providers pull bids when volatility rises. When bids disappear, market sells have nothing to hit. Price drops until it finds a real buyer. The drop triggers stop-loss orders. Stops become market sells. More selling hits a thinner book. That's why you see air pockets. And if someone wanted to force a rejection at $94, the easiest way is not to sell forever. It's to break the psychology and let the vacuum do the rest. Is it manipulation? The legal versus mechanical question. Let's handle this like adults. A market can be rigged in the sense that it is dominated by a few players with size, information, and structural advantages, without every action being illegal. Manipulation, legally, is a specific thing. Spoofing is a specific thing. Collusion is a specific thing. But even without illegal conduct, a concentrated market can produce outcomes that look engineered. If 3 or 4 huge entities are the marginal sellers at a key level, then the market will reflect their risk tolerance, and the crowd will feel like it is not allowed to cross, because in practice, the gatekeepers are the ones who can write the biggest checks. So you don't need a shadowy meeting for the outcome to be consistent. You need concentration, leverage, and an incentive to defend a line. That's it. Why would they do it? The incentive map. If a large dealer is short and a break threatens a squeeze, their incentives are prevent the break, reduce exposure into weakness, keep volatility contained, avoid forced buying at worse prices, keep collateral demands stable, avoid becoming the internal headline. Their job is not to be right. Their job is to avoid the tail event. And a disorderly $94, $100, $110 run can look like a tail event. That's why the defense is fierce. The systemic. Fear. Why this matters beyond silver. Silver is not just a metal. It's part of the broader collateral and derivatives ecosystem. It touches dealer books, client hedges, structured products, and balance sheet constraints. If silver explodes upward, you don't just get losses on shorts, you get volatility spikes, margin requirements increase, funding costs rise, risk limits get hit, portfolios delever, correlated positions unwind. It's the same story as any leverage event. One market moves, collateral gets demanded. Other markets get sold to raise cash. Stress spreads. So if you're a risk manager looking at a crowded short exposure in a thin market, you defend the line before the chain reaction starts. Paper versus physical. Why the argument never dies. If silver is so scarce, why can paper price drop? Because futures price is the price of immediate financial settlement in a leveraged venue. Physical price is the price of metal in hand with fabrication, shipping, and inventory constraints. They are linked, but they are not identical. In calm periods, they track closely. In stress, they can diverge. Paper can drop on liquidation. Physical can stay firm on tight inventory. Premiums can widen even as spot falls. So if you're watching $94 get defended on paper while physical doesn't relax, you're seeing the split. The basis story: why paper can slam while physical stays firm. Let's do one more structural concept that clears up a ton of confusion: the spread between futures and physical. Futures are a financial contract. Physical is inventory, fabrication, and delivery logistics. In a normal world, futures and physical prices stay close because arbitrage keeps them honest. If futures are too high, you can sell futures and buy physical. If futures are too low, you can buy futures and sell physical. But in stress, arbitrage gets broken by real-world friction. Inventory is not sitting at your doorstep. Fabrication capacity is limited. Shipping takes time. Credit lines matter. Margins can spike. And the players who can do large arbitrage are the same players managing balance sheet constraints. So the paper market can get hammered by leveraged liquidation, while physical doesn't soften much, because the physical market is constrained by supply chain reality. That divergence is why the community never lets this argument die. It's also why $94 matters so much. If paper breaks into a squeeze, physical tightness can amplify the panic. The math of the defense. Clean version. Assume, for illustration, that across large dealers, there is a net short of 40,000 contracts near the front months. Contract size, 5,000 Oz. Notional ounces, 200,000. Now do the P&L from $94 to $100. $6 move x $5,000 per contract, or $30,000 per contract. $30,000, $40,000, $200,000. That's $1.2 billion. Now do it from $94 to $110. $16 move x $5,000, $80,000 per contract. $80,000 x $40,000, $3,200,000. And in squeezes, you don't get to cover at the last traded price. You cover through gaps. You chase. So the loss can be bigger than the clean arithmetic before we even count margin hikes and funding stress. So when you ask, why was silver rejected at $93.90? A mechanical answer is because a break above $94 increased the probability of price getting pulled into the $95-$100 option zone, which increased the probability of a delta hedging feedback loop, which increased the probability of a disorderly move, which increased the probability of a margin cascade, which increased the probability of losses large enough to trigger systemic stress on concentrated exposures. That's the chain. That's the math. A quick simulation of the squeeze moment. Imagine the exact moment silver prints $94.10. Breakout funds trigger buys, stops above the high trigger buys. Dealers who are short calls begin buying futures to hedge. Shorts who were fine at 93.80 start panicking at 94.20. Brokers increase intraday margin because volatility is expanding. Some leveraged shorts get forced to cover. Covering is buying. Buying gaps price into $95. Now the $95 strike zone is live. Hedging accelerates again. Notice what's missing? There is no decision by the market to punish anyone. It's just a staircase of forced actions. That's what makes these moves terrifying for large shorts. They are not in control once the staircase starts, so they fight to prevent step one. What to watch next? Signs. The fortress is cracking. If you think the market is controlled, you don't just want a story, you want a checklist. Here are the signs the fortress is weakening. The level gets tapped repeatedly, and the rejection gets smaller each time. Supply is being absorbed. Volume increases on green candles into the level. Buyers are not flinching. Pullbacks become shallow. Instead of dropping $2 or $3, it drops 40 cents and stabilizes. Sellers are losing momentum. You see gap up prints that hold. Offers are gone. Options open interest migrates upward. Calls roll from $95 to $100 to $110. The magnet is moving. Physical tightness signals intensify. If physical premiums rise while paper gets slammed, paper is losing credibility. None of these is a guarantee, but together they tell you whether the gate is holding or breaking. Two things can be true. Two things can be true at the same time. Silver can be driven by real supply-demand forces over the long run. Industrial demand, investment demand, and physical availability matter. In the short run, price can be dominated by positioning, leverage, and a small number of large participants defending risk lines. So if you felt like silver was not allowed to cross 94, you're not crazy. Markets with concentration can behave like that. The question is not whether a wall exists. The question is how long it can hold. Because every time you defend a level, you spend ammunition, you show your hand, you invite pressure. And if the underlying forces keep pushing, industrial draw, physical tightness, monetary stress, eventually the wall cracks. When it cracks, it won't look polite. It will look like gaps. It will look like panic. It will look like the tape rewriting itself. The final paradox. Here's the paradox that makes this market so addictive. The more a level is defended, the more important that level becomes. Because defense creates a story. Story attracts attention. Attention attracts capital. Capital tests the level harder. Every rejection writes a bigger promise into the chart. One day, this breaks. So even if you think the game is rigged, the rigging has a cost. Walls are not permanent. They're paid for. And eventually, the bill comes due. Usually at the worst possible moment. Yep, proof vs. pattern. Pattern is not proof. A chart can't prove intent. A rejection can't prove collusion. Proof would require audited data, communications, or enforcement actions. But traders don't wait for courtroom proof to manage risk. They watch for patterns that repeat under pressure, so the responsible way to say it is, we can't prove motive from one chart. But we can describe the mechanics that make a defense rational for concentrated shorts, and we can show the math that explains why the line matters. The anti-trap checklist. Let's make this practical, because the worst thing you can do in a market like this is get emotionally harvested by the same pattern again and again. If you're watching a fortress level, here's how to think. Breakouts aren't confirmed by the first tick above the line. They're confirmed by acceptance. Price trades above, pulls back, and buyers defend the new floor. A fake-out break is often a spike and immediate reversal. That's where late buyers get trapped and forced to puke at the worst price. Watch the speed. When price crawls into a level, it's easier to defend. When price jumps into a level on gaps, it signals offers are thin, and thin offers are how walls collapse. Watch the reaction to bad news. If price refuses to drop on bearish headlines, it can be a clue that selling power is exhausted. Bonus tell. If open interest rises into the rally, that often means new positions are being added, not just shorts covering. If open interest drops hard on the rejection, that can signal forced liquidation, and if a big delivery month approaches with tight registered inventory, pressure can build where paper and physical stop agreeing. Real fast. None of this is a guarantee. It's just how you avoid being the liquidity for somebody else's exit. And again, not financial advice, just structure. Whether you call it manipulation, control, concentration, or just brutal market physics, the $94 wall is a message. It says, there is a risk threshold on the other side of this line. When you see that, don't argue with it. Study it. Because once you understand the math, the fear turns into clarity. If you want part 2, I'll do it. The 3 triggers that force a cover: margin, gamma, and physical drain. Drop a comment with one word: fortress. And if you're new here, subscribe, because this market is not normal, and the next move may not be either. Stay sharp.